You just checked your credit score, 780. Excellent. You feel proud. You've been paying every bill on time, keeping your credit utilization low, managing your accounts perfectly. You think, I'm crushing it financially. My credit score proves it. Then you look at your actual financial situation. $3,200 in your savings account. $18,000 in credit card debt. You're managing well with minimum payments. $34,000 in student loans. A car payment of $520 per month. And despite your excellent credit score, you're living paycheck to paycheck, stressed about money, and nowhere close to being wealthy. Here's what kills me. You've been sold one of the most destructive financial lies in modern America, that your credit score measures your financial health. It doesn't. Your credit score measures one thing, and one thing only: how profitable you are to lenders. And I'm going to show you exactly why obsessing over your credit score is costing you $250,000 in lifetime wealth, and what you should be focusing on instead. My name is Max, and I want to help you learn how to make your money work more for you in your life. Today, I'm exposing the credit score myth that keeps millions of Americans financially trapped, why the system is designed to reward behavior that keeps you broke, and the specific metrics that actually matter if you want to build real wealth instead of just being a profitable customer to banks. So, let's get started, and please make sure to hit the subscribe button and give this video a thumbs up if you like it. Okay, let's talk about what your credit score is actually measuring, because once you understand this, you'll see why it's a terrible indicator of financial success. Here's the thing. Your credit score is calculated by 3 credit bureaus: Equifax, Experian, and TransUnion, using a formula developed by FICO. The score ranges from 300 to 850, and it's based on 5 factors: payment history, 35%, credit utilization, 30%, length of credit history, 15%, credit mix, 10%, new credit, 10%. Now, notice what's not in this formula: your income, your savings, your net worth, your investment accounts, your actual ability to build wealth. None of that matters to your credit score. Here's what most people don't realize. The credit score system was created by and for lenders. It's designed to predict one thing: the likelihood that you'll pay back debt. That's it. It's not measuring financial health. It's measuring how reliably you'll make payments on borrowed money. In fact, here's the disturbing part. The perfect credit score customer, from a lender's perspective, is someone who carries a balance month to month, making minimum payments on time, paying interest indefinitely. You know who has lower credit scores than that person? Someone who pays off their credit cards in full every month and never pays interest. And someone with no debt at all. This is where it gets really interesting. According to research from the Federal Reserve, there's actually a negative correlation between credit score and net worth at the extremes. Some of the wealthiest people in America have mediocre credit scores because they don't use debt. And some people with perfect credit scores are drowning in managed debt with minimal savings. You've been taught to worship a number that measures how good you are at borrowing money, not how good you are at building wealth. And that's the lie. Let me show you exactly how obsessing over your credit score instead of actual wealth building costs you $250,000 over your lifetime. Scenario 1. Credit score optimized. Meet Sarah. She's obsessed with her credit score. She's got 3 credit cards. With small balances, she rotates to maintain optimal utilization. A car loan at $485 per month for a newer car. Good for credit mix. Student loan she's paying minimum on. Good for payment history and credit mix. A mortgage at the top of what she was approved for. Lenders loved her credit score. Her credit score, 795. Excellent. Her monthly debt payments, $2,850. Her monthly savings, $200. Her annual interest paid on consumer debt, $4,200. Over 30 years, interest paid on consumer debt, $126,000. Savings accumulated, $72,000 with modest investment returns. Net position, minus $54,000 plus. She's still paying a mortgage. Scenario 2, wealth optimized. Meet Marcus. He doesn't care about his credit score. He's got one credit card, paid in full monthly, no interest, no utilization games, no car payment, drives a paid-off $8,000 used car, aggressively paid off student loans in 3 years, bought a modest house well below approval amount. His credit score, 680. Good, but not excellent. His monthly debt payments, $1,200, just mortgage on modest house. His monthly savings, $1,850. His annual interest paid on consumer debt, $0. And over 30 years, interest paid on consumer debt, $0. Savings accumulated, $666,000 plus. Aggressive investing of the difference. Net position, plus $666,000 and owns home outright years earlier. Same income. Different priorities. A $250,000 plus difference in wealth outcomes. Sarah has the better credit score. Marcus has actual wealth. The credit score told you nothing about who's winning financially. Now you might be thinking, but Max, you need a good credit score to get a mortgage. Do you? Marcus got a mortgage just fine with a 680 score. He just paid a slightly higher interest rate, which he offset by buying a house half the price Sarah did. The math still worked dramatically in his favor. Let me break down the specific ways the credit score system misleads you into thinking you're doing well when you're actually destroying your wealth. Misleading factor number 1, rewarding debt carrying. Your credit utilization ratio, how much of your available credit you're using, is 30% of your score. The optimal utilization is around 30%. But here's the trap. This rewards keeping balances on your cards instead of paying them off completely. Someone with $10,000 in available credit and a $3,000 balance has optimal utilization and pays interest. Someone with $10,000 in available credit and a $0 balance has too low utilization by some scoring models and pays zero interest. The system literally rewards the behavior that costs you money. Misleading factor number 2, credit mix incentive. Having different types of credit cards, car loans, mortgages, student loans, improves your score. This incentivizes taking on debt you don't need just for credit mix. I've seen people finance furniture, take out small personal loans, or buy cars on credit specifically to build credit mix. They're paying interest to improve a score that measures how profitable they are to lenders. It's insane. Misleading factor number 3, the debt treadmill. Your length of credit history is 15% of your score. This means keeping old credit accounts open forever, even if you don't use them. But here's what most people don't realize. This keeps you perpetually in the credit system, perpetually available to be marketed debt products, perpetually thinking about credit instead of wealth. Misleading factor number 4, punishing payoff. When you pay off a loan completely, student loan, car loan, personal loan, your credit score often drops temporarily because you've closed an account and reduced your credit mix. The system punishes you for becoming debt-free. Let that sink in. Misleading factor number 5, ignoring wealth fundamentals. You can have an 800 credit score with $500 in savings, no retirement accounts, and $60,000 in debt. You can have a 650 credit score with $200,000 in investments, no debt, and complete financial independence. The credit score tells you nothing about actual financial health. Additionally, there's a psychological component. People treat their credit score like a report card for financial success. They obsess over it, check it constantly, make financial decisions to optimize it. Meanwhile, they ignore their net worth, their savings rate, their debt-to-income ratio, the metrics that actually matter. All right, if credit score is the wrong metric, what should you be tracking? Here are the numbers that actually predict financial success and wealth building. Metric number 1, net worth. Assets minus liabilities. This is the only number that actually tells you if you're building wealth or destroying it. Calculate it monthly. Track the trend. If it's going up consistently, you're winning. If it's flat or declining while you have an excellent credit score, the credit score is lying to you about your financial health. Target benchmarks by age, rough guidelines. Age 30, 1 times annual income and net worth. Age 40, 3 times annual income and net worth. Age 50, 6 times annual income and net worth. Age 60, 8 to 10 times annual income and net worth. Metric number 2, savings rate. Percentage of gross income you save and invest each month. This is the single best predictor of wealth accumulation. Below 10%, struggling, unlikely to build significant wealth. 10 to 20%, building wealth slowly, on track for traditional retirement. 20 to 30%, building wealth quickly, possible, early retirement. Tristis meet percenti plus, wealth accumulation on steroids, financial independence achievable. A person saving 25% of a $60,000 income will build more wealth than a person saving 5% of a $120,000 income. The savings rate is what matters, not the income level. Metric number 3, debt to income ratio. Monthly debt payments divided by monthly gross income. This tells you how much of your earnings are being extracted by lenders. Below 15%, excellent, most income available for wealth building. 15 to 25%, moderate, manageable, but limiting. 25 to 35%, high, significant wealth destruction occurring. Above 35%, critical financial stress and vulnerability. Credit scores don't measure this, but this ratio determines whether you can actually build wealth or whether you're trapped servicing debt. Metric number 4, emergency fund coverage. Months of expenses covered by liquid savings. This measures actual financial security. 1 to 3 months, minimal security, vulnerable to emergencies. 3 to 6 months, good security, can handle most surprises. 6 to 12 months, excellent security, high resilience. 12 plus months, exceptional security, complete peace of mind. Someone with a 750 credit score and 1 month of emergency savings is far less financially secure than someone with a 650 credit score and 12 months of expenses saved. The credit score tells you nothing about this. Metric number 5, income replacement ratio. Percentage of expenses covered by passive/investment income. This measures progress toward financial independence. 0 to 10%, early stage, fully dependent on active income. 10 to 25%, building foundation, reducing dependence. 25 to 50%, significant progress, partial independence. 50 to 75%, advanced stage, near independence. Septendismit PhD percenti plus, financial independence achieved. This is the metric that determines freedom. Credit score is completely irrelevant to this. You are probably wondering, okay, but don't I need a good credit score for emergencies? Let me address that directly. Look, I'm not saying credit scores are completely irrelevant. There are specific situations where they matter. But here's the key. They matter far less than you've been told, and obsessing over them causes more harm than good. Situation 1. Getting a mortgage. Yes, you need a decent credit score for a mortgage. But here's what most people don't realize. You don't need an 800. You don't even need a 750. For most conventional mortgages, a score of 680 to 700 qualifies you. You might pay a slightly higher interest rate than someone with 780, but the difference is often minimal, maybe 0.25 to 0.5%. On a $300,000 mortgage, the difference between 4.0% and 4.5% interest is about $90 per month. Over 30 years, that's about $32,000 more in interest. Sounds significant, right? But compare that to the cost of obsessing over credit scores, carrying debt to maintain utilization, taking loans you don't need for credit mix, buying more house than you need because you were approved for it. These behaviors easily cost you $100,000 to $250,000 in lifetime wealth. The better strategy, get your score to 680 to 700 through responsible basic behavior. Pay bills on time, don't max out cards, then stop caring about it and focus on building actual wealth. Situation 2, renting. Some landlords check credit scores, but again, you don't need perfect credit. You need acceptable credit, usually 650 plus. And many landlords care more about income verification and rental history than credit score. Situation 3, insurance rates. Some insurance companies use credit-based insurance scores, but the impact is often overstated. The difference in premiums between good and excellent credit is usually $10 to $30 per month. Again, compare this to the wealth destruction of credit score optimization behaviors. It's not worth it. What doesn't require good credit? Building wealth through investing, starting a business bootstrapped, living a fulfilling life, achieving financial independence, becoming a millionaire. Some of the wealthiest people in America have mediocre credit scores because they don't borrow money. Credit scores measure your relationship with debt, not your capacity for wealth creation. Here's what I need you to understand. The credit score system isn't just financially misleading. It's psychologically manipulative. Trap number 1, false achievement. Seeing your credit score go from 680 to 750 feels like an accomplishment. You get a little dopamine hit. You feel like you're winning at finance, but you haven't built any actual wealth. You've just optimized your attractiveness to lenders. This false sense of achievement prevents you from doing the actual work of wealth building because you already feel successful. Trap number 2, gamification of debt. The credit score system gamifies debt management. You're trying to win by reaching 800 plus, and the game rules reward behaviors that profit banks. Carrying balances, maintaining debt diversity, staying perpetually in the credit system. You're playing a game designed by your opposition lenders, where winning the game means you lose financially. Trap number 3, status signaling. People brag about their credit scores the same way they brag about income or possessions. I just hit 800 becomes a status marker. But here's what most people don't realize. You're bragging about being an optimal debt customer, not about being wealthy. It's like bragging about being a bank's favorite customer. Congratulations, they're making a lot of money off you. Trap number 4, distracting from what matters. Every minute you spend optimizing your credit score is a minute not spent on actual wealth building. Every mental cycle dedicated to, should I pay this card down to 30% utilization or 10%, is a cycle not spent on, how do I increase my savings rate to 25%? The credit score obsession is displacement activity that feels productive while being fundamentally counterproductive. Seriously, the system has convinced you to obsess over a metric that measures how good you are at enriching banks, while ignoring the metrics that measure how good you are at enriching yourself. All right, here's the alternative approach that builds actual wealth instead of just credit scores. Step 1, basic credit hygiene, not optimization. Do these things. Pay all bills on time, set up autopay. Keep credit card utilization below 50%, or just pay them off monthly. Don't open unnecessary credit accounts. Check your credit report annually for errors. That's it. This gets you to 680 to 720, which is sufficient for any legitimate financial need. Stop there. Don't optimize further. Redirect that energy to wealth building. Step 2, aggressive debt elimination. Pay off all consumer debt as fast as possible. Yes, this will temporarily hurt your credit score when you close accounts. Who cares? You're building wealth, not a credit score. Use the debt avalanche method. Minimum payments on everything. Maximum payments on highest interest debt first. Get to zero consumer debt, then stay there forever. Step 3, wealth metric tracking. Set up a simple spreadsheet. Track these monthly. Net worth, assets minus liabilities. Savings rate, percent of income saved/invested. Emergency fund coverage, months of expenses. Debt to income ratio, investment account balances. Watch these numbers trend up. This is real progress, not credit score theater. Step 4, automated wealth building. Set up automatic transfers. 401k. Contribution, 15% plus of gross income. Roth IRA, max it out, $7,000 to $8,000 per year depending on age. Brokerage account, whatever else you can save. Automate this so it happens before you can spend the money. Your wealth metrics will climb without you thinking about it. Step 5, ignore credit score fluctuations. Your score will go up and down based on various factors. Ignore it. Check it once a year to make sure there are no errors or fraud. Otherwise, don't look at it. It doesn't matter. What matters? Is your net worth increasing? Is your savings rate above 20%? Do you have 6+ months of expenses saved? Are you investing consistently? If yes to those questions, you're winning financially regardless of whether your credit score is 720 or 780. Now, I know you may be frustrated hearing this because you've spent years trying to optimize your credit score. I get it. But that effort was misdirected by a system that profits from your confusion about what actually matters. Here's your real financial scorecard. This is what actually predicts whether you'll build wealth or stay trapped. Question 1. Is your net worth increasing every year? Yes arrow. You're building wealth. No implies. You're failing financially regardless of credit score. Question 2. Can you cover 6+ months of expenses from savings? Yes. Implies you have real financial security. No implies you're vulnerable regardless of credit score. Question 3. Are you saving and investing 20% plus of your income? Yes arrow. You're on track to build significant wealth. No implies you're unlikely to achieve financial independence. Question 4. Is your debt to income ratio below 20%? Yes arrow. Your income is mostly yours. No implies lenders are extracting too much of your earnings. Question 5. Do you have investment accounts that will fund your retirement? Yes arrow. You're building long-term security. No implies you're setting up for financial stress in old age. These 5 questions tell you more about your financial health than your credit score ever will. And notice none of them require debt. None of them reward being a profitable customer to banks. They measure actual wealth, actual security, actual progress toward financial independence. Look, here's the reality. Your credit score is a lie. Not in the sense that the number is inaccurate, but in the sense that what it claims to measure, your financial health, is completely false. Your credit score measures how profitable you are to lenders. That's it. It's a tool created by and for banks to identify their best customers, people who will reliably borrow money and pay interest for decades. You've been taught to worship this number, to optimize it, to feel proud when it goes up. Meanwhile, that obsession has distracted you from building actual wealth. The person with an 800 credit score and $5,000 in savings is financially weaker than the person with a 680 credit score and $100,000 in investments. But the credit score told you the opposite was true. Stop playing the game designed by banks to keep you profitable to them. Start playing the game that actually builds wealth, high savings rate, aggressive debt payoff, consistent investing, growing net worth. Get your credit score to good enough, 680 to 720, and then forget about it. Redirect all that mental energy and optimization effort toward the metrics that actually matter. Your assignment this week: calculate your real financial scorecard, net worth, savings rate, emergency fund coverage, debt to income ratio. Track those numbers monthly for the next year and watch them trend up while you stop checking your credit score. Then drop a comment below with your net worth and your savings rate, the numbers that actually matter. Let's build some accountability around real wealth building. Subscribe to this channel because we're going to keep exposing the systems designed to keep you broke while making you feel successful. Hit that thumbs up if this video changed how you think about credit scores. Your credit score is a lie designed to benefit banks, not you. Stop optimizing it. Start building wealth instead. The choice is yours. Play their game and stay profitable to them, or play the real game and build the financial freedom you actually want.